Today's screencast is about installment loans. We're going to start by looking at the comic on this page. Man, I really need to do well in this class to keep up my grades. I need scholarships for college. Yeah, I'm glad I have a soccer scholarship next year. I don't have that pressure right now. You're so lucky. College costs so much these days, I guess I'll have to take out a loan. Installment loan basics. You can see that Todd and Ramon are both finding out that college is going to be expensive. Even though Ramon has a scholarship, he will soon find out that there are many other items and services to pay for when he goes to college. What are some ways Todd and Ramon can pay for college and other expenses? What's the difference between a scholarship and a loan? Basically, we've talked about installment loans briefly before in previous lessons, and this is going to expand on that material a little bit more. What is an installment loan? Generally, an installment loan is when you borrow a set amount of money and repay it in fixed monthly payments, or installments, for a specific period of time. These loans are usually repaid over several years. An installment loan is different from an open-end credit, such as a credit card. With open-end credit, the lender allows you to borrow against a pre-approved credit line. Therefore, your payments depend on how much you borrow. Types of installment loans. There are two types of installment loans: secured loans and unsecured loans. Secured installment loans. A secured installment loan is one in which you offer collateral for the loan. You must give up the collateral to the lender if the loan is not paid back as agreed. The interest rates for secured installment loans are comparatively lower than unsecured loans. A car loan is an example of a secured installment loan. Collateral. Collateral is security that you provide a lender. Giving the lender collateral means that you pledge an asset, like your car, to the lender with the agreement that the lender can take it to help repay the loan if you don't make the payments as agreed. Generally, if the collateral is not enough to repay your loan, you are still responsible for the remaining loan balance and the other costs. For example, if you do not make payments on the loan for your car, the lender can repossess or take away the car. The lender will then try to sell the car. You will have to pay any difference between how much the car sells for and what you owe on the loan, plus fees and interest. Unsecured installment loans. An unsecured installment loan is a loan that is not secured by collateral. An example of an unsecured installment loan is a student loan. Loan tips. When getting a loan, beware of companies and websites that charge high rates and application fees. Look for hidden charges. Shop around, compare offers. Activity 1 is going to introduce some terms. There are 4 terms to keep in mind when looking at installment loans: annual percentage rate, or APR, fixed rate loan, variable rate loan, or a finance charge. Terms. APR. The cost of borrowing money expressed as a percentage rate on a yearly basis. When shopping for the best loan rates, compare the APRs rather than the interest rates, because APRs reflect both the interest you are charged as well as additional fees. This is the single most important tool to use when comparing loan offers and advertisements. Fixed rate loan. A loan that has an interest rate that stays the same throughout the term of the loan. Most installment loans have fixed rates. Variable rate loan. A loan that has an interest rate that might change during any period of the loan, as written in the loan agreement or contract. Finance charge. The dollar amount the loan will cost, including interest, service charges, and loan fees. So we don't have to worry about these questions right now. We're going to scooch down to the 4 C's of decision making. Lenders generally review the 4 C's to decide whether to grant you a loan. The 4 C's are capacity, capital, character, and collateral. Capacity refers to your present and future ability to meet your payment obligations. This includes whether you have enough income to pay your bills and other debts. Capital refers to the value of your assets and your net worth. Character refers to how you have paid bills or debts in the past. Your credit report is one tool lenders use to consider your willingness to repay your debts. Collateral refers to opportunity or assets offered to secure the loan. Loan approval. When you are applying for a loan, the loan officer may ask the following questions involving the 4 C's of lending. Capacity. Do you have a job? How much money do you make each month? What are your monthly expenses? Capital. How much money do you have in your checking and savings accounts? Do you have investments or other assets like a car? Character. Have you had credit in the past? How many credit accounts do you have? Collateral. Do you have assets to secure the loan beyond your capacity to pay it off? The following characteristics show that a borrower does not have capacity, capital, character, or collateral and should not receive a loan: making late payments consistently, filing for bankruptcy, having property repossessed or foreclosed, having a court order requiring a debtor to pay money to the creditor. We're stopping the reading for today right here. Go back to today's lesson, and then go ahead and take the reading check below. If you need any help, you know how to contact me. Good luck!